Banks were supposed to be the part of modern life that felt solid. You put money in, they keep records straight, suspicious activity gets flagged, and behind the scenes, a giant machine quietly keeps everything moving. But now that machine is changing fast. Artificial intelligence is moving into the banking system.
At the same time, in a recent survey American Banker conducted, 61% of bankers said they're not confident in their company's ability to combat fraud.
At the same time, criminals are learning to use the very same tools against it. That is why this story matters. AI is not just helping banks work faster. It is also exposing weak points in trust, identity, fraud controls, customer service, and even the infrastructure banks now depend on.
But in the digital world, you have to treat people in a very different way. You don't necessarily know them, so you have to try and collect the data assets that allows you to be able to understand who they are and why they're doing something in general.
And that is what makes this moment so dangerous and so fascinating. Regulators, central banks, and finance officials are all saying roughly the same thing. AI can make banking smarter, but if it is rushed, outsourced too heavily, or trusted too easily, it can also make the system easier to manipulate, harder to understand, and more fragile under pressure. The first crack is identity. Banking runs on one basic assumption. The person on the other side of the screen is who they say they are. AI is making that assumption shakier. Deepfakes, voice cloning, synthetic identities, forged documents, and AI-assisted scams are becoming more convincing at exactly the moment banks are pushing more activity online. Federal Reserve Vice Chair Michael Barr warned in 2005 that banks are now frontline defenders against deepfake-enabled fraud because they sit directly in the path of payments and customer data. The European Central Bank has also warned that AI can facilitate fraud and cyber attacks, while Hong Kong police reported multiple deepfake fraud cases, including cases involving pre-recorded video conferences that produced major losses. This is what cracking the banking system really looks like. Not a movie-style instant collapse, but a slow erosion of the signals banks used to trust. A familiar voice, a face on a call, a normal-looking instruction, a document that appears clean. AI is removing the old tells that used to make scams easier to spot. The second crack is fraud at scale. A human scammer can only fool so many people in a day. An AI-assisted operation can generate fake voices, fake messages, fake documents, and fake urgency over and over with almost no slowdown. That changes the economics of financial crime. The Federal Reserve has pointed to the rise in check fraud, citing FinCEN data showing that from February through August 23, there were more than 15,000 reports tied to check fraud involving more than $688 million in transactions, including attempted fraud. Treasury has gone even further, saying enhanced fraud detection tools, including machine learning AI, helped prevent and recover more than $4 billion in fraudulent and improper payments in fiscal year 2024, including $1 billion tied to Treasury check fraud. That tells you two things at once. First, the fraud problem is big enough that AI is already saving serious money. Second, the fraud threat is growing so quickly that even the government is racing to automate its defenses. AI is not only becoming a weapon against banks, it is becoming a required shield. The third crack is decision-making. Banks are using AI for credit scoring, fraud detection, customer service, compliance support, software development, and internal knowledge work. ECB Banking Supervision said in late 2025 that European banks showed a strong increase in AI use cases between 23 and 24, especially in credit scoring and fraud detection. The U.S. Treasury's AI report said nearly 8 in 10 financial firms were implementing generative AI for at least one use case, with many expecting their model inventories to expand as adoption grows. On paper, that sounds efficient. Faster reviews, better pattern recognition, lower costs, more tailored services. But there is a hidden problem. The more banks rely on models to rank risk, detect fraud, and shape customer outcomes, the more the system starts depending on decisions that even insiders may struggle to fully explain. A loan denial, an account freeze, a suspicious activity alert, or a customer escalation may all begin to come from layers of models, data pipelines, and vendor tools that are technically impressive but operationally opaque. The danger is not just bad judgment. It is confidence in judgment that nobody can fully audit in real time. That leads to the fourth crack: false confidence. AI can be extremely good at finding patterns, but banking is full of edge cases, rare events, messy human behavior, and shifting fraud tactics. A model trained on yesterday's reality can fail in tomorrow's panic. The Financial Stability Board warned that wider use of complex AI could increase model risk if financial institutions cannot properly validate, monitor, and correct those systems. It also warned about data quality problems and weak governance. In plain English, banks may begin to trust systems that look scientific, but are still vulnerable to drift, hidden bias, bad inputs, and blind spots. Worse, when AI becomes normal inside a bank, employees can start treating outputs as if they carry extra authority simply because they are machine-generated. That is one of the most underappreciated risks here. AI does not have to be completely wrong to cause damage. It only has to be trusted a little too much, a little too often, in systems that move huge amounts of money. The fifth crack is concentration. This is where the story gets bigger than one bank. The Financial Stability Board has warned that AI in finance may amplify systemic risk through third-party dependencies and service provider concentration. Many banks do not build every model, chip stack, cloud environment, or training pipeline themselves. They rent intelligence from a growing chain of outside providers. That means more institutions may end up leaning on the same vendors, the same infrastructure, the same model families, and sometimes the same data assumptions. If those providers fail, get breached, go offline, or produce faulty outputs at scale, the damage does not stay neatly inside one institution. It can spread. The FSB also warned that common models and data sources could increase correlations across markets. In other words, AI does not just create smarter banks. It can create more similar banks. And in finance, too much similarity can be dangerous because it means many firms may react to stress in the same way at the same time. The sixth crack is the human layer. Banks are not just buying AI, they are reorganizing around it. Customer service teams are being supplemented by chatbots. Risk teams are being fed machine-generated alerts. Compliance teams are using tools to sift documents, summarize policies, and surface anomalies. That can absolutely improve speed and reduce workload. Gao noted that AI can improve customer support, strengthen security, and help reduce false positives in areas like anti-money laundering alerts. But even that positive story has a catch. If workers become over-dependent on AI summaries, recommendations, or triage systems, then the bank may become faster while also becoming more brittle. The system feels efficient right up until something unusual happens, and the humans in the loop are no longer close enough to the raw details to catch it early. Banking failures rarely begin with a dramatic explosion. They usually begin with small overlooked signals. AI can help find those signals, but it can also bury them under automation if governance is weak. So where does that leave us? Not in a future where AI destroys banking overnight, and not in a future where AI simply saves banking either. The real future looks more complicated. Banks that use AI well may stop more fraud, process information faster, and serve customers better. Banks that use it badly may become easier to spoof, slower to understand their own risks, and more dependent on outside systems they do not fully control. That is why this moment feels like a stress test. AI is revealing that the banking system was never built on code alone. It was built on trust, verification, governance, redundancy, and human judgment. AI can strengthen each of those pillars, or crack them. The difference will come down to whether banks treat AI as a tool to support disciplined decision-making or as a shortcut around it. So here's the question I want to leave you with. If your bank starts relying more on AI to verify identity, detect fraud, and make decisions about your money, would that make you feel safer or less in control? At Machine Minds, your opinion matters to us. Until next time, take care.